This is an important judgment by the tax court. And I emphasize that it's by the tax court because it might go in appeal, but it nevertheless deals with a couple of very important principles, and should it be upheld in appeal, I think might have quite far-reaching consequences. Certainly, SARS will raise this judgment in respect of defences to GAAR assessments and indeed to certain other assessments that SARS will raise, and I think this is a very, very important judgment. For those of you who don't know me, I'm Niku. I study tax. I like doing tax. Right. This is training is designed for my staff and can be relied upon by my staff only. For those of you joining online, it's for your interest only. Let's get into the case, right? The facts of the case, and you will see, for those of you who work in practice, this will look very familiar, and you will see why it's an important transaction, right? So, the appellants, the taxpayers here, held shares in a company called RUS. I'm just going to call it RUS, right? There's another company called Ancient who wanted to acquire the shares in RUS through one of its related or subsidiary companies called SRIA. Now, instead of a direct sale from the appellants to SRIA, they decided to do what they called a pre-closing dividend to existing shareholders. Then the intended purchaser, SRIA, will subscribe for new shares in RUS, and they will use that money to fund a dividend payment to the dividend payment that was declared, the pre-closing dividend, and the existing shareholders will then sell their diluted shares to SRIA for R1,000. Sound familiar? Yes, very familiar. It's called dividend stripping, right? It's exactly what paragraph 43A is designed to counter, right? So, let's see, where does this go? Just the 4 steps explained again. RUS declared a pre-closing distribution of approximately 274 million. Then in step 2, what the would-be purchaser or the purchaser eventually subscribed for new shares, and it paid approximately 280 million. RUS used the subscription proceeds to pay the dividend to the existing shareholders, and the existing shareholders then sell what was now 0.01% following the subscription by SRIA into RUS, sold it for R1,000. The economic result is that the existing shareholders of RUS exited and SRIA bought the shares. That's the economic result that followed. Right? They sold the shares, they exited the shares. Right? Now, what is the tax effect of that transaction absent the GAAR? And this, by the way, was a very common scheme, if you will, before 2017. Very common. If you didn't do it, you were a loser, right? Kind of thing. That's kind of how popular it was, right? So absent the GAAR, this is what the tax consequences were, and that's why people did this, right? Or part of the reason people did this. The dividend the appellants received is exempt, right? Because it's intercompany dividends, right? Before this transaction was implemented, some of the shareholders in RUS were natural persons or trusts, and so they had to introduce an intermediate holding company to get the exempt dividend, so they did 42s, right? To interpose companies so that they can get the exempt or the dividend exempt. But the principle is the dividend they receive is exempt. The subscription proceeds has got no tax effect really because it's no disposal. The final sale for R1,000 is no material capital gained. The structure avoided the CGT that would have been paid had the shareholders of RUS simply sold their shares to Ancient or to SRIA, right? Because when the dividend was declared on the shares, that is exempt dividend, right? And the sale of the shares, because remember, if you pull out all the value of the company is worthless. That's why they could sell the shares for $1,000 afterwards, right? So the CGT is immaterial, it's negligible, right? But they effectively converted taxable proceeds into exempt dividends. And like I said, pre-2017, that was a very, very common transaction. And in fact, this happened just before 43A was amended. I think 43A, we'll look at it somewhere in the stars, became effective on the 19th of July 2017. This was a February 2017 transaction, right? So SARS says, hang on, the GAAR applies to the composite transaction. So the 4 steps seen as a whole, right? And they say they disregard the dividend and the subscription steps, and they treat the transaction as a normal sale. Because really, in economic reality, that is the substance of the transaction. They said, I'm going to apply the GAAR, and I'm going to impose CGT on this, and of course, naturally followed understatement penalties, provisional tax, underestimation penalties, and interest. Right. So the taxpayer's defence, quite broadly, insofar as it relates to the GAAR assessment, is the taxpayer said, no, look, I applied the choice principle. So for those of you familiar with the GAAR rules will know that there's this principle from ConAg, confirmed in APSA now recently in the Constitutional Court, that if there is more than one way of achieving a commercial result, then it's free for the taxpayer to choose the most tax efficient route, right? That doesn't mean that the GAAR must apply. That's fine. That's perfectly permissible, right? And effectively what they said is the taxpayers here, they said that, hang on, we wanted to sell the shares in RAS to Ancient. In fact, when you look at the history, there was a whole history behind them approaching the shareholders and saying we want to buy. And before that, there was a different transaction. They called it the Marble transaction or the Marble project, Project Marble, where some of the shareholders were in any event looking to exit partially, right, but not entirely. And then Ancient came along and said, I want to take over full control. And then the main shareholder said, okay, we won't sell everything if there's a CGT implication. And then some tax advisor came and said, hang on, I've got this thing in my pocket that we've designed, which is used as a tool that we sell to people to convert what is effectively CGT into exempt dividends, which is exactly this structure, very common, right? And so they said, okay, fine. They said, okay, now we're going to do it, right? But they said their defense to SARS's basis for the GAAR is they said that SARS, the point is we were going to sell the shares regardless. Or, no, our commercial point was to sell the shares. That was the commercial aim. And so if we have a commercial aim, we can choose to execute or to achieve that commercial aim in a tax-efficient manner, and that's what we did, right? And so therefore the GAAR ought not to apply. That's the basis for their defense. Insofar as the understatement penalties are concerned, bear in mind that this is when the understatement penalty regime was different before 1 April this year, when the bona fide inadvertent error defense was moved from as a gatekeeper. We had training on this before, so I'm not discussing it again. But they said they relied on professional advice to get around the penalty. They disclosed the transaction as a reportable arrangement, because indeed when you do subscription and dividends, it's a reportable arrangement. I think in excess of 10 million rand is a reportable arrangement in terms of Section 35 of the Tax Administration Act. So they reported it to SARS. So they're saying that when innocent taxpayers here, somebody trying to dodge tax, we won't be reporting things to SARS and getting professional advice. So that was kind of their defense on the penalty. They also challenged, and this is quite an interesting point that can get quite technical, is they challenged the SARS's alternative basis for pleading their case. Because one of the things SARS did is they said that initially they said that the whole or the composite transactions, all 4 steps, are the arrangement, right? That was the initial basis for their defense. And then in their pleading, they said in the alternative, the subscription and the dividend is the arrangement that they want to attack. Why would they do that? Because if you look at the composite transaction, there's going to be an argument that there's a commercial aim. But if you look at the subscription and dividend alone, what's the commercial aim, right? That's what they did. And the taxpayer challenged that basis for SARS's alternative pleading to say that's not permissible in terms of Rule 31, it's innovation. Also, it's not permissible in terms of ATJ because of Erasmus, which we had training on before. You will recall, for those of you joining online, you haven't missed. If you missed it, it's on the YouTube channel. Right, so the court's judgment, in short, before we get to my takeaways on the judgment, is the alternative argument pleaded by SARS was struck out, right? SARS cannot plead things in their Rule 31 statement that creates new assessments, right? I've written an article about this before. Litigation or Rule 31 is not a workshop for fixing defective assessments, SARS. You must fix it. The assessment must be right at the time you raise the thing, not when lawyers get involved, because I'm going to bring an application to have it struck. Mika and I worked on something of this yesterday, right? So, but the court said regardless, I can look at the transactions and the transaction steps individually. Even though SARS said the arrangement is the composite arrangement, or the composite transactions, I can look at each step of it. And so when I look at each step of them, I don't have to look at what the ultimate commercial goal was. I can look at what the commercial purpose was of the subscription and the sale proceeds. And therefore the GAAR assessment was upheld on SARS's initially pleaded case, initially stated case. The court upheld that the composite transaction was impermissible. The dividend and subscription steps were disregarded and recharacterized, and said CGT must be calculated normally. The understatement penalty was remitted on the basis of Thistle and Coronation SCA judgments, not constitutional court judgments, right? And the interest was confirmed, right? That was, in short, what happened, right? Now, the takeaways for me from this judgment, we can get very technical on the GAAR, right? But there's a couple of takeaways here for me on this judgment that I think is important, that I think is of more general importance than GAAR, because GAAR assessments are far and few in between, although they seem to be getting more regular. Right, so SARS's original assessment defined the entire four-step composite transaction as the GAAR arrangement, and then they tried to change their case in the pleading. And this is something, it's a move they keep on pulling, right? Because what happens is the auditor rush, well, I'll tell you what my experience is. I can't say for sure what happens, right? But here's what I think happens, right? In my limited experience, is auditors rush to raise assessments. They don't think about everything. They just jump to conclusions. They raise assessments, right? Now we object. They pretend to look at the objection. Then it goes to ADR, where they pretend to listen to. I'm kidding. Sometimes they do. Sometimes it's constructive, but not always. And then you get to litigation, and now a lawyer gets appointed, either in-house or external, and somebody looks at the case and they go, oh, fuck. This is not going to stick. This assessment is not going to stick. And then they start trying to fix their defective assessments in pleadings, which is not permissible, because those things are novations of factual and legal bases. Understatement penalties and prescriptions are top of the list for impermissible novations, in my experience, added to pleadings, which can be struck. And oftentimes, if you're successful in having those struck, half of the case falls away, because then SARS hasn't made out a case. Right. And so the court here said again, just confirmed the Erasmus principle. I don't want to get into that again. Right. Why SARS pleaded the alternative? Because you have to always ask the question. When you read a Rule 31 statement, one of the first things I do is I compare the Rule 31 to the audit findings and finalization letter to see where there's differences, right? The reason they are raising alternatives is because they are weak somewhere, right? Something is broken somewhere. And so if you can identify that, you already have a strong edge in your dispute process, especially when you get to litigation, right? And the reason I think, and I've said this before, in this particular case, why SARS changed or tried to plead the alternative, and remember, the alternative was, it's not the composite transaction. So it's not all four steps seen as a whole being the arrangement that sole or main purpose must have been to obtain a tax benefit for their GAAR assessment to stick. No, it wasn't that. It was the subscription for shares and the pre-closing dividend. Because now we ask the question, what is the sole or main purpose of that arrangement? And then that's different, right? That's why they changed it. It turns out, in this particular case, the judge thought it's not relevant, right? Because the court said, well, regardless of whether or not I look at the arrangement as being the subscription and the dividend, if I look at those steps in the composite transaction, those steps lack commercial substance. There's no point to them. There's no point for you to subscribe, to have declared the dividend, and for the other guys to have subscribed for shares, other than tax. And so therefore the GAAR assessment stuck. Right. So the point on this judgment, again, it just confirms, and there's a string of judgments in the last couple of months, SARS cannot fix their assessments at Rule 31 stage. And it is crucial, and this is something that I've said before, is if you think for 1 second that SARS will point out their attempts to fix their assessments in Rule 31, you are extremely mistaken. They will not. They will simply plead their case. It's up to you as the taxpayer to identify novations, raise them, and follow the correct procedure to have them struck. Because if you don't, they will stay, and the court will adjudicate it on those impermissible grounds, because the rules say the matters and the issues are those contained in the pleadings. And if SARS's impermissible grounds are there, the court's going to decide it on the basis of what's in the pleadings. So you have to take action, and you have to have it struck. And why would you do that? Why would you do that? If your case, I'm dealing with a case now, it's a USP issue, right? SARS carries the burden of proof on USP. I'm going to potentially raise an exception to their pleading. So you haven't made out a case because you are relying on completely irrelevant things. In fact, your assessment or your grounds pleaded are vague and embarrassing. If that is struck from their pleading, what case is left for them on understatement penalties? Nothing. What do I win? All the understatement penalties, right? Right. The second takeaway for me from this judgment is it asks questions about the choice principle. Here we clearly had a transaction that clearly had a commercial purpose, right? The Koornhagen judgment confirms, and this court says they accept the Koornhagen principle as confirmed in APSA by the Constitutional Court, that you do have a choice to structure your affairs tax efficiently. The difficulty I have with this judgment is SARS said the arrangement is the composite transactions, all four considered as a whole, and so we must ask the question, what is the whole of the arrangement's purpose? And I said the whole of the arrangement's purpose is to sell the shares, right? That's the commercial purpose. But the court says no, we can apply this choice principle more narrowly. We can look at the individual steps and we can ask what is the commercial purpose of the individual steps. And if the choice of those individual steps was solely tax, then I can apply the GAAR regardless, right? The important point is when you look at the choice principle, the way it was framed in Koornhagen is the court said, if the taxpayer wants to reach a commercial result, then he can structure his affairs to achieve that commercial result, right? So it's almost as if we say the steps in between don't matter as long as we get to a commercial result. Whereas this court says, no, that's not what is meant by the choice principle. We can look at the individual steps. And so my question is this new, right? I don't think it's new. We still have the choice principle, but it does certainly narrow in my mind the extent that the choice principle can be applied. We have to now look at each and every step and ask what is the point of this step. Although I think that's always been the case, but there was the Koornhagen judgment that said look at the result and see, look, is the result commercially defensible? But now we need to look at whether or not each step is defensible, right? If you look at and the court says, if I look at the subscription and the dividend, there's no commercial purpose. The taxpayer at some stage, I think, tried to argue that, look, there could be many reasons why the deal would be structured like this, right? It could be that the acquirer wants his balance sheet to show that he subscribed for shares for whatever reason he wants to raise funding or whatever the case might be, right? So there could be a commercial reason. The court said, okay, I accept that, but there was no evidence led to this effect. In fact, the only evidence that was led was SARS's witness, which was an expert witness, and his testimony was he's only seen this sort of thing in tax schemes, right? There's no commercial purpose for it unless you can say there's a commercial purpose for the share subscription and the dividend. But in this case, the court said there's none. In fact, all the evidence, when you look at the sequence of events, which is not on the slides, is the taxpayer didn't want to do the transaction if there was CGT. And then he got advice. And then the advice was, we can do it this way, then there is no CGT, right? There's no reason for it. In fact, then the advisors of the sellers, the tax advisors of the sellers and the purchasers met, and they said, okay, fine, we can do it this way to accommodate your desired tax efficiency. So there was no commercial purpose other than achieving this tax benefit. And the court said, well, when I look at that composite, or that not composite, but that particular steps, or those two steps, there's no point to it. Now here comes the kicker for me. For those of you familiar with this, you will know that paragraph 43A of the 8th schedule and 22B, or whatever the section was, or is, was specifically inserted to achieve exactly the result SARS was seeking here and got, right? Not inserted, amended. 43A has been there for many years, but it was significantly amended in 2017. Now the question is, why didn't SARS apply that? Because it's much easier. It's a very straightforward inquiry. Was there a dividend, an extraordinary dividend, and was there a sale of the shares afterwards? And if it is, then you get to the same result that SARS was seeking here. So why didn't SARS do this? Well, this transaction happened in February, and the paragraph 43A in its amended form applied only from the 19th of July. So SARS used the GAAR instead. Why does this matter? There's an effective date for paragraph 43A, which is the 19th of July. There are other effective dates as well, which I'm going to get into now. If the GAAR was always sufficient to attack these transactions, it exposes all of those previous, just do a quickie 42 and then a dividend and then we sell the shares, right? Because now people are going to say, oopsie, yes, there's the GAAR, but that only applied from there, so everything before that was safe. Nope, not according to this judgment, right? So yes, there are things like prescription and procedure that SARS must follow to open old assessments. That doesn't matter. The point is the GAAR has always been sufficient, at least in this particular case, where there was no motive for the subscription and dividend. There was a commercial motive, right? Let's look at further amendments to paragraph 43A, because what happened is people were doing this, so I was very much aware of it, right? This case now confirms they could always have applied the GAAR, but they decided in 2017 to introduce 43A, right? Then people came up with ways to get around the amended paragraph 43A. They would do, for example, deferral transactions to make sure that the dividend is declared on one share, but the buyback is on another share, right? Because 43A required the dividend and the share to be linked to each other. And then they said, oh, hang on, I've got a smart plan. What we'll do is we'll just do an intergroup transaction, so we do the dividend there and sell there, and then we still get the same result from, and we get around paragraph 43A, right? And that was effective for disposals after 1 January 2019. Then in 2019, there was a further amendment to 43A where they said that, because the other way people then got around 43A is, okay, well, what I'll do is I'll do an extraordinary dividend, and then the other guys will subscribe for shares, and I will dilute to 0.01%, but I'll never sell that 0.01%. And so absent a disposal, 43A can't apply, right? And then they amended 43A to say, well, in those cases, 43A applies anyways, right? So now, if we look at this judgment, which is now relating to a transaction, which is effectively exactly what 43A is aimed at, then all of these effective dates really become largely redundant, right? Because SARS can say, yeah, we made amendments which are only effective from then, but we could just as easily apply the GAAR to those transactions because the section didn't apply. But clearly, this is an avoidance arrangement, clearly. And in fact, there was another thing I'm trying to remember now where SARS said in a recent EM that there's a certain transaction or a certain other way they haven't yet. Anyway, I'm not going to get into that. But the point is this, is the GAAR is going to be there. Whether or not this judgment is taken on appeal, it probably will be. I think the transaction value was like 400 million or something in total, or was it 270? I forget the numbers now. So I'd imagine it would be taken on appeal because it raises further questions on how this composite transaction versus those particular steps. But be that as it may, right? I've discussed this, that the point is that pre-existing transactions are exposed now, and that's why I made the point earlier that to say that remember this is a tax court judgment, so it doesn't set a precedent. And so the question is for me as a taxpayer and an advisor, what do you tell your clients who's had similar transactions? Do you say wait and see if a higher court upholds this, or do you VDP now before the shit hits the fan? Because I'd imagine that they're going to come back, because remember, these transactions ought to have been disclosed through the reportable arrangement system. So yes, there will be some that didn't disclose, but I'd imagine SARS has a whole list of transactions, right, that are similar to this, that has been reported to them in terms of section 35 of the reportable arrangement section. So now the question is, what do you do? Do you wait for this? I'm going to reserve my comment for now, but I will say that my prima facie view is I think this is going to be upheld. It is just too obvious an issue for, I think, for any court to go, yeah, this is fine. It's two-steps pieces of paper that you sign that evades tax. I can't think that at a principal level the court's going to say, "Oh, I think this should be fine. We can allow this." So I don't know. My view is I'd be erring on the side of caution. What is important is also what I thought of is this court said in this judgment and the court made quite a point of it to say, SARS, you can apply the GAAR, but you must go and raise the assessment, taking properly into account the base cost of the transaction, right, of the asset, right? So don't just go and take proceeds times the CGT rate, go and do it properly, right? The court made quite the point of it. And when I thought about that, and I thought about the effect of GAAR and the amendments to 43A, you know, the dilution in particular, which I think was the 2019 amendment, when people would just dilute without selling to get around 43A. That section, funny enough, says the CGT is calculated as the CGT on the proceeds alone, right? So now, and I'll leave it as a rhetorical question, is if I was SARS, I would choose 43A for transactions falling post that amendment, because that gives me a higher CGT result because I don't have to take into account the base cost. Right, we'll see. I'm going to leave it at that. Understatement penalties. So the SARS imposed 75%. When you look at the understatement penalty percentage table, there's a specific category for impermissible avoidance arrangements, and it's 75%. And SARS said, well, I succeed on the GAAR, you must impose a GAAR penalty, because that's the behavior category in the USP table that I must impose. And the court says, no, that is not true. The fact that I can find in your favor on the merits of your assessment does not mean the penalty follows automatically. The penalty is concerned not with the outcome, SARS, and this is crucial, because at last the courts are seeing this. The understatement penalty is not concerned with the outcome of SARS' assessment, but the taxpayer's conduct that caused it. And how often do we see, in cases that we deal with, SARS will say, I can make an audit finding, or I can find that you've underdeclared income, therefore you are grossly negligent. All the time, right? In fact, in 99% of the time. What they're doing is they are making the penalty hinge on the outcome of their assessment, which is what the court here says you can't do. You must look at the taxpayer's conduct during to and the process leading up to the assessment. And here the court said, when you look at these guys, right, they got advice, and the advice did caution against the GAAR, but it said it doesn't think the GAAR applies. And they did properly consider the transaction, and they did disclose it to SARS. So here, you can't say, because I make a finding on the outcome of your assessment, I uphold your assessment, therefore the GAAR applies. I must still look at what is the conduct, what behavior is the taxpayer guilty of. And at this point in time, the issue, of course, was that, this is very important, the law was, of course, that the bona fide inadvertent error was a gatekeeper. Right, so if you could show bona fide inadvertent error, the rest of the behaviors become redundant, where now it's changed, right? Would the result have been different here if it was after the fact? I don't think so, on the basis of the Thistle judgment, because they took advice, and so you'll go through the categories up to substantial understatement, and then you'll get the remittance anyway, under 223, sub 3, right? So, but this point that USP is concerned with conduct and not outcome is critical, right? Remember that bona fide reliance on advice is still a very strong defense, but not as strong as it was before, right? It's going to help you, well, I say not as strong as it was before. It is probably equally as strong, but it's going to take you longer to get to the same result, because you have to now argue through all the penalties effectively to get to 10, substantial understatement, because you got advice, and then you can get remittance because you've got advice, either because it's a bona fide inadvertent error, or because you got the written advice, full disclosure was made, etc., etc. Right. We all know what the position is after the 2026 amendment. I have a whole training session on that. Right. Provisional tax underestimation penalty. This is the point, part of the judgment that baffles me entirely. So obviously the taxpayers didn't declare the CGT on this, so they would have clearly understated their provisional tax, and SARS imposed the provisional tax underestimation penalty. And they asked for remittance under paragraph 22 that says if the calculation was seriously calculated with due regard to the factors having a bearing thereon and was not deliberately or negligently understated, right? And the court goes as far as to say, well, it seems to me like that's exactly the case, but I won't decide. I'm going to remit it back to SARS to make a decision. It's almost as if the court goes into everything, finds in favour of the taxpayer, and then says, no, I'm going to remit this question back to SARS. And the basis for that decision seems to be the court saying that SARS has got the discretion, right, in the first instance, and the court doesn't want to exercise that discretion in the first instance. It must go back to SARS. Now, I don't know whether that is true, because to get an understatement penalty, if you follow the tax court or the Tax Administration Act and the tax court rules properly, to get a USP issue, an underestimation of provisional tax issue in court, you should have first asked remittance, where SARS would have exercised their discretion not to. Then you would object and appeal. So the court would not be exercising a discretion at a first instance. It would be reviewing the discretion exercised by SARS, and it could have made the decision, right? Unless in this particular case, for some reason, no remittance request was ever made. And then I don't know how the issue of the provisional tax underestimation penalty actually ended up as an issue in dispute in the tax court, because it can only get there if there was a decision not to allow a remittance request, which is the scheme of the GAA, right? Because then, remember, then what the taxpayer needs to prove in the tax court is that SARS's decision not to remit was wrong. In fact, section 106 or 102 says exactly that, right? So I think either these guys didn't ask for remittance, in which case I question why it was in front of the court at all, or if they did, I think the court respectfully erred in saying, I don't want to exercise my discretion. Right, that's the point I raise here. Insofar as the final summary is concerned, taxpayer lost on the GAAR, right? Erasmus is still important, not only in GAAR assessments, but on the principle of novation and the impermissibility of new grounds. The choice principle survives, right? But I think it now operates a little bit more narrowly than I think was perceived before. We'll see where this ends up. The judgment raises important questions about GAAR exposure before 43A amendments, right? Because everybody felt before 43A we were safe because of the choice principle, because of GAAR. Can't apply to that, now it can, well, at least according to this judgment. Penalty exposure must be assessed separately from the assessment. And this is a point that I have raised consistently and that I've raised in many cases I'm dealing with SARS is the penalty exposure and SARS's assessment of the penalty must be a wholly separate exercise. They must say, okay, I can make a finding that you didn't include this in income or you didn't deduct this as an expense. That's my assessment. Now my next inquiry is going to be, what was your behavior? Why did you claim this? Why did you not include this in income? What was the surrounding circumstances? They hardly ever do that. And I've said this before, the reason for that is because the USP system is the replacement of the old additional tax system. And the old additional tax system simply said if you can make an audit finding, you can impose up to 200% penalties, right? That is not how the USP system works. It's been how many years since 2012, right? When the USP system was introduced and the additional tax system was scrapped, but we still find that the facts are not set out on which they rely for the imposition of penalties. It is a separate exercise. The USP does not follow the assessment outcome. It follows the question of the behavior of the taxpayer. And that is crucial. I can almost guarantee you that there are thousands of assessments with USPs that if you follow the correct process, you'll have those pleadings struck and they will have no case on the USPs, in my view. I could be wrong, could be mistaken, but that's my view.